Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. Ross tells us the markets are shifting into a place where there could be some great buying opportunities in the next few weeks. He takes a look at gold, which hit new highs, energy, the U.S. and Canadian dollars. Ross also has a special offer for our listeners. Veteran trader Victor Adair weighs in on the uncertain market conditions caused by President Trump's tariff threats. He tells us whether it's better to buy physical gold or gold stocks and looks into why copper has decided to join gold in setting record highs. CEO of InkResearch.ca, Ted Dixon, gives us the lowdown on the Canadian Insider Index, which has been performing well. He takes a look at gold, especially junior miners, AI, and whether Trump 2.0 is different than the original Trump administration. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Always a pleasure, Jim.
Ross, how would you describe what happened on the stock markets this week?
Well, it conforming just so nicely to the model that we've been working with here. It was 2 weeks ago, we got the capitulation lows on the S&P, the NASDAQ, the Russell, and, the optimum was that we would have a nice short covering rally, like an ABC style rally, an A up, B correction, and C for a second leg. We're looking for anywhere from a 38 to 50% retracement rally. And my gosh, we got that beautifully in place here in the middle of the week. And some good overbought signals, and then started to roll over. And that's the model that we've got. We've updated the charts for everybody. We're very pleased with the way this is unfolding. It's not just that there's a sort of a template that we're working from. It's that the various technical pieces are just fitting into place one by one on most of these turns. So the next few weeks, we got some great-looking opportunities out here. I'm going to take advantage of them. I mean, this break that we saw on Friday is just right part and parcel with what was to be expected. So a new low close below the ones that we put in here in that second week of March looks to be in the offing. And, if the subscribers are looking at our material, they've got a pretty good handle on what to be looking for shortly after that.
What's going on with gold?
That has been the safe haven. We've spent the better part of a few years here just, in a consolidation phase starting really from, since 2012 when we were up around $1,900 and we pulled back to just shy of 1,000. That consolidation or that pullback, since it turned the corner, the measurements have been the up into the 3,000 plus level, and here we are as of this week. We've closed off at just over 3,000. I think about 3,080. We've got some great upside Fibonacci targets coming into play very soon, and looking for some pretty good corrections after that, because everybody in the world has been chasing this product more than anything else out there, and the enthusiasm has just gone through the roof. This is when you have to be very, very cautious. You know what to be watching to determine when the parade is coming at least to a corner, and it's time to take a few dollars off the table. So there's still some room left, I think, but there's I think some exciting days to be had after that. The miners have done well up until a short while ago, but they've become excessive, and really they're having trouble pushing much further on the upside this week. So, maybe it's the early part of a consolidation or distribution starting as far as that's concerned. So, overall, it's been a market of rotation since December or January when the broad markets topped, and then other areas have been coming to life. You got all these metals, gold, copper, and silver, all making decent moves. The copper and silver, we updated the research this week. Got a pretty good handle on what to be looking for there. And the energies have been another one that have come to life. We take a look at the ETFs. The XLE is held up very well during this decline that we've seen in particular, and like in the AI stocks. The staples, XLP, the utilities, the XLU, the bonds, all have been beneficiaries of the overall distribution that's happening as part of this big 17-year cycle rolling top that we are into. I think this is now the sixth example that is conforming well on a rotational basis.
What's going on with the U.S. and Canadian dollars?
The U.S. dollar has bottomed out. The lows that we put in a couple of weeks ago had good oversold readings in them. We're at 103.70 on the dollar index. It's had a decent bounce in here. I think, though, you're probably looking at something probably shy of 106 for an upside target before the next leg, I would think, to the downside. Canadian dollar against the U.S. has just got to the point where it's really not doing anything to speak of. We had downside capitulation readings and oversold readings back in December. We've thrashed around back and forth now, particularly with the day-by-day changes in tariff announcements, and who knows what it will finally be as of next week. But for now, the Canadian is, looks like it's got a decent chance here to bounce, and not a big one, but towards the upper end of the range we've had in the last couple of weeks.
Ross, anything else you want to remind us of?
Yeah, well, things are on a roll right now for us. The patterns are fitting into place so nicely. So for anyone who wants to come on board, we're 25% off for annual subscriptions at this point. You go to the website, chartsandmarkets.com. You'll find a link there on the front page, and we would welcome to see you come aboard.
Ross, thank you so much for being on This Week in Money.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia. His website, Adair.Ca. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Well, good to be back with you, Jim. It's always a pleasure.
We've had gold and copper hit all-time highs this week. The stock market seems stressed over tariff uncertainty. But before we get into individual markets, what's your current macro view of the planet's financial state?
Well, I'll tell you, it's just sit in front of my screens as I do. It seems the market is choppier than it has been before. You know, as you've just mentioned, yeah, we've gone to new all-time highs in gold, and that should be signaling, I suppose, something going on in the way of stress in the markets. The stock markets, again, as you're saying, just, you know, they're feeling stressed. Certainly, a big part of the uncertainty in the market is, in two words, it's Trump tariffs. Okay, I mean, that is for real. It's, I think maybe we're signaling, you know, a major change in the way the world works. I know you interview Marty Armstrong from time to time on your show, and I know Marty's, for the past several years, he's been forecasting out that about this time, 25 to 28 or something, you know, the sort of the world as we know it is going to change hugely. And, you know, so maybe this is the start of that. But, you know, let me put it to you this way. I guess I don't pretend that I've got a great crystal ball. I really do believe that I make money from trading because I'm just so focused on managing my risk. I just don't even think about the possibility of I've got a great crystal ball. So I think that's I don't know, that's maybe the way I approach things right now anyway.
Gold has rallied about $450 since the start of the year and closed this week at new all-time highs around $3,100. What are your thoughts on gold?
Well, I've got a lot of thoughts on gold, I tell you. And let me just say this. On my weekly blog, the Trading Desk Notes, which is at Adair.Ca, I wrote all about gold last week. Usually I cover a number of different markets, and last week that would be, what was it, March the 22nd, it was all focused on gold. And, you know, going back to some of the history, I mean, I was trading actively with one of the big American commodity brokerage firms in 1979 when, you know, the Russians invaded Afghanistan, and that sort of gave us the final leg up from about $450 to $850 on the gold price. We hit all-time highs at that period of time. You know, I covered some of the things that happened back then. But, okay, for right now, I think, you know, in no order of importance, just kind of as they come into my mind, I think most of the folks that are trading gold understand or believe that the elephant in the room is central bank buying. So for the last 3 years, the central banks of the world, that the information that they give to the World Gold Council and other people that collect this data is they've been buying about 1,000 tons of gold each year. And I say the information that they give, it's just kind of assumed that some of the countries out there just don't tell the whole truth and nothing but the truth when they're reporting their gold buying. But that's about a third, roughly, of the newly mined gold that comes out of the ground every year. So that's a huge buyer. And, you know, it started to show up, I guess, a couple of years ago when we saw the correlation between gold and the U.S. dollar and gold and interest rates started to break down. I mean, traditionally, rising interest rates and a rising U.S. dollar were just toxic, were kryptonite, you know, for the gold market. And here, you know, this time around, as I say, starting a couple of years ago, that wasn't happening. And my good friend Martin Murenbield, who's been a world-renowned gold analyst for decades, was pointing out this breakdown in the correlation, and we were looking for why is that? And then, you know, gradually we came around to believing it was we got a new big kid on the block, and it's the central banks. Just to put that in perspective, back in the last time we had a bull market in commodities was between 2009 and 2011. And during that period of time, the gold price went up about 150%. A lot of other commodities raced higher as well, and commodity currencies were up. But during that period of time, central banks were selling, on average, in total, all the central banks in the world, about 500 tons a year. destocking, as it were. The people that were running the central banks at that time thought, gold was like the barbarous relic. You didn't need it to get rid of it. Let's get something safe and secure like treasury bills or whatever. And you compare that sale of 500 tons a year to now the buying of 1,000 tons a year, just shows you how important the central banks have been. Another one of my thoughts has been about how the gold shares have on balance not kept up with the gains in gold bullion. And my short answer is the central banks are buying gold, they want the physical gold, and they want it delivered to their vaults. They don't want, gold shares, they don't want silver, and so on. That's what they want. I mentioned silver. Back in 2011, at the height of that last real boom we had in the commodity market, it took about 30 ounces of silver to buy an ounce of gold. These days, it takes about 90 ounces of silver to buy an ounce of gold. That's just that gold-silver ratio. So the mining companies, back in the old days, people would, if they were bullish on gold, and they would look at buying gold mining shares because those shares would have extra leverage to a rise in gold price. Let's say their operating costs, I should say, stayed the same, but what they're selling, their product, gold, is going up. Their ratios are all going to improve, and people did see gold shares rise more aggressively than gold bullion. But I think since then, the world has become sensitive to certainly country risk, where people can. There's no more fixed asset than a mine, and a mining company goes into a country, spends billions of dollars, say, to get a mine and gear, and then the country says, "Oh, we're going to change the rules now." And we've seen that certainly recently in Panama with the copper mine, with West Africa. So people are sensitive to that. If you're bullish gold, you want to buy gold. Don't buy shares on gold. Is kind of where I'm going with that. So, yeah, gold's had a great run. The surprising thing to me is it's been so orderly. The run that I was through back in 79 into 80, it was like a rocket ship taking off. You could actually sort of tell how old somebody was if they'd get, sort of misty-eyed about the good old days back when gold had that great, taking off like a rocket period of time. Anyway, lots of thoughts on gold. I see ETF sales are picking up again in gold. Again, that was interesting. The last couple of years, the gold ETFs, it was net selling we saw there. I think, first of all, with gold ETFs, the first thing that comes to my mind is that people who maybe cannot buy bullion, like, for instance, if you were a pension fund and you thought you'd like to have some gold, I think a lot of pension funds would be restricted, from going out and buying bars of gold. So they could buy shares in a gold mining company, for instance, or this gold ETF. So the market is at all-time highs. I think it clearly is. When gold is at all-time highs, it's signaling, it always is signaling, some stress in the markets, whether it's geopolitical stress or financial stress or something. And yet the rally has been so orderly here over the past couple of months that you say, what, really, are they that worried about things? I'm a little uncertain as to why it is as high as it is and why the rise has been so orderly. And maybe, there's another mystery buyer or something out there in the gold market, like the central banks that we're unaware of at this point.
The S&P rallied to all-time highs in mid-February, but it's tumbled about 10% since then. Has the market dropped because people are worried about tariffs?
I think the tariff thing has been very important to the market, but to go to the setup, you were saying, yes, we had reached all-time highs in mid-February is what happened. We had, the market had been marching higher throughout 2023. There was an important low in October of 22, and throughout the year of 2023, I think the market was up 20-25%, and about the same thing again in 24. So here we'd had this tremendous rally in the stock market. I think altogether it was up about 80% at the February highs from the lows that we hit in 2022, and it seemed to me that the market was just pricing in perfection everywhere. And the cherry on top was the new golden era that was going to happen because Trump was in charge, and boy, things were going to get better. So, as my mom would say years and years ago, it was cruising for a bruising. The market was, pricing perfection, and, we've had a 10% correction. I think there's still a lot of folks out there that really believe that there's value in being in the stock market. We've seen a massive switch from people, switch into, call it, passive investing, where people just continually put money into the market. The drill there is you put money in every month. You don't try to time the market. You don't try to pick stocks. You just buy the whole market. And if you keep doing that, by the time you retire, you'll be rich. And it's a very seductive story. It's worked so well for the past number of years. We've seen a massive switch from actively managed money to passively managed money.
But Victor, now things are a lot more volatile. Is it time to really stay sharply focused every day on what's happening?
I don't think that's the right thing for everybody to do, for sure, or say most people. I mean, if you're dedicated to being a trader, then you're going to do that for sure. But you can go too far down the rabbit hole, I think, trying to catch every wiggle and squiggle that'll happen day in and day out. So, yeah, I'm really not sure. I think for what we're doing here, just kind of a macro view on things, the S&P and the other stock markets got too high in mid-February. We've had a correction. Certainly, Trump has introduced a lot of uncertainty into the market, and there's even thought that with the tariffs we could go into a recessionary environment. So that's put some pressure on the market, and I think that's one of the reasons we are here, closing at the lowest levels on the S&P that we've seen in 7 months.
Copper was trading around $4 in early January. Since then, it's gone to all-time highs around $5.35 this week. What's going on with Dr. Copper?
Well, it's been a bit of a mystery on copper. Yes, it's had a great run here in the last 3 months. But, the market had a great run and hit all-time highs in May of last year with a lot more fanfare, let's say. Got up to $5.20. And that was an all-time high. And then, the fanfare, as it were, just kind of dissipated, and the market dribbled off. It seems people lost interest, and we got back down to around $4 a pound at the end of last year. So now it's had this run up to new all-time highs, but I'm telling you, it just doesn't seem like the market has had everybody and his dog chasing it. We certainly don't see that in volume in New York. We don't see that in the open interest, although it's up a bit. And I noticed just, the other day, really, copper shares of, or at least the ETF for copper mining companies is not, up anywhere near as much as copper. One of the fellows that I talked to that's really savvy about this, a veteran floor trader in New York, and he and I are sharing these thoughts. It looks as though what's happening in copper is happening outside of the United States, not on the COMEX futures market in New York, which is just kind of plodding along, sort of doing the steady level of business that it was doing before. That maybe, copper getting positioned ahead of tariffs, if they're going to put tariffs on copper. I'm not sure. Copper can be a bit of a mystery metal. And I used to say to my son, what are we trading when we're trading copper? Is it pallets of red metal, or is it some kind of a over-hypothecated financial instrument in China? There was a lot of that going on. So I'm a little puzzled and a little feeling uninformed, I guess, about why we've had this sharp move in copper. I mean, the story about the electrification of everything, that's been out there for half a dozen years, so why has it all of a sudden come back? Short answer is, I don't know.
The U.S. dollar rallied about 10% from September to January, but since has dropped about 6% to this week's lows. What's driving the greenback?
Well, for folks that have listened to us for some time, so the past few years, I've generally been bullish on the U.S. dollar. And one of my expressions, and this goes back honestly 40 years when I used to be a currency analyst, is that money comes to America for safety and opportunity. Opportunity like there's whether it was the dot-com boom in '99 or the Mag 7 boom the last couple of years, there was opportunity in the American stock markets that there just wasn't available elsewhere. And when the Russians are invading whoever they are this week, capital or whatever other reasons, people get worried. You kind of go to the safety of the United States. So that was a powerful force, and certainly I've written about this in my blog many times. We saw the American stock market so outperform the stock markets in the rest of the world that they didn't even count. It didn't matter. It was just, and I'm I'm exaggerating for effect. Okay, forgive me for the people that want me to be more precise, but really that was the sense of it. There was just so much going on in America, and it just kind of was a magnet for capital. Now here, going back a few weeks, maybe a couple of months, I was writing about what I called the peak of American exceptionalism. And again, that sort of the cherry on top was Donald Trump and the new golden era that was going to happen. And that's when the U.S. dollar peaked in January. And when I say peaked, it was at a 2-year high, that's the U.S. dollar index, but outside of a couple of weeks back in October of 2022, the U.S. dollar was at a 23-year high. And that's the U.S. dollar index that everybody uses. There's another U.S. dollar index, and that's the trade-weighted one. And the trade-weighted one has a lot more Asian currencies in it, because no surprise, America does a lot of trade with Asia. And it was at all-time highs. So the U.S. dollar was really, really high to where it had been historically in 2020 as we started this year. And, like the stock market was at an all-time high, so, we were due, I suppose, or overdue for a correction, and I think that's what happened so far. And the spark for the correction might have been the uncertainty that Trump brought to the table, the split that was happening, I guess, between Europe and America. We had the Germans change their constitution so that they could go into debt to finance not only defense but infrastructure and probably some green projects as well. And we had the euro rallying on that. And one of the things that certainly supported the strength in the U.S. dollar the past 2 years was the fiscal stimulus that came from the government. Now we're going to get this fiscal stimulus in Germany and other places in Europe. And, maybe for a separate subject, maybe also fiscal stimulus in Canada. And that's caused the U.S. dollar index to fall about 6% from the highs it was at in January, which were high, to where we have been lately. Where we go from here, it is this change in the world, and some folks, just love to hate the U.S. dollar. But I think when push comes to shove, if there's more uncertainty and more geopolitical stress, the U.S. dollar is still going to look like the safer place to be.
The Canadian dollar traded between 72 and 76 cents in 2023, the first half of 24, but fell to just 68 cents in early February when Trump announced tariffs on Canada. Now it's back around 70 cents U.S. What do you think is going to happen to the loonie? And for people who don't know why we call it a loonie, that's the picture that's on the Canadian $1 coin. It's a loon.
Well, anybody that doesn't know why we call it
a loon, and it's a loon bird, not some Looney Tune.
The Canada. Okay, we've talked about this a bit before, but certainly in September of last year, and to some degree earlier than that, I started to see a buildup of speculative short positions in the futures markets for the Canadian dollar. And when I say a build-up, I mean, as we got into the fall, it was massive. There was just, compared to history, we've been trading the Canadian dollar futures since the late 1970s, mid-1970s. So over all that period of time, this was the biggest by a country mile. The speculators were looking at Canada, and they were shorting it, and they were adding to their positions. Now, that paid off. I mean, the Canadian dollar fell, as you were saying, from that 72 to 76 cents. We got all the way down to 68 cents the beginning of February when Trump shocked Canadians, certainly, but the world, with the 25% tariffs on Canada and Mexico, which, of course, were canceled a couple of hours later, and the Canadian dollar had its biggest one-day rally in, I don't know, years. It rallied about a cent and a half that day. But, yeah, Canada, or I should say the speculators had really loaded up to the gills with these short positions, and over the past 6 weeks or so, Canadian dollar's gone practically nowhere. It just kind of flatlined. And I'm thinking that the speculators, and I see they're starting to pare away their positions or take profits, whatever. I think the speculators may be saying, hey, maybe we've seen the worst of it. And to get out of their positions, they need to buy the Canadian dollar. So there may be some net buying on the Canadian dollar as the speculators want to get out of their positions. Now, the people who want to be bearish Canada can paint a really bleak picture, because we're getting bullied by the American neighbors, and thousands of people are going to lose their jobs, and on and on and on. But I hear that, and they may be right, but I just look at what the market's doing. And the Canadian dollar has been a flat line here for the last 6 weeks or so, and if I'm short, which I'm not, I'd be thinking, there's no meat left on this bone. Let's cover that position and move on and do something else. So on the basis of positioning and trading and what the sentiment looks like, I'd say the Canadian looks like maybe that's as low as it's going to do. And as I said moments ago, I don't have a great crystal ball to manage my risk. If I'm wrong about that, and I'd change my mind in a heartbeat.
Trump announced tariffs on foreign-made automobiles this week. Next week, he'll announce more tariffs on what he calls Liberation Day. What are your thoughts on those tariffs, and do they make you change the way you trade?
Well, I thought it was maybe an insight into what he's thinking, and, let's not get too carried away with that, but 46% or so of the cars that are sold in the U.S. are imported, and I think that pisses them off. Okay? For instance, there was an additional thing that came out with that, and this didn't get a lot of airtime, but he's now going to allow people to deduct the interest they pay on car loans from their taxes if the cars are made in the United States. So he's really, I think this is where he's at. He does want to sort of bring manufacturing back to the United States. I think that is his goal, to get the Rust Belt back in operating condition again. And I think these two things really point to that being, the core of what he's trying to do. Now, I'm not going to try to get inside his head and all that sort of thing. I see him as having he's like an angry guy who wants to change things, and he's got a blunt instrument, tariffs, that he's going to change things with using tariffs. And there's going to be unintended consequences. There's going to be collateral damage, from this blunt instrument that he's using to try to bring manufacturing back to America. Now, that's my thought. Could be wrong. And what do I do? How do I change my trading? I'll tell you, I trade a smaller size than I would otherwise. I try to be prepared that I'm going to be dead wrong and could be, the market could move against me sharply in a heartbeat. So I need to be prepared for that. So I trade smaller size and watch whether or not, I've got the same trade on. In other words, like lately, if I was short bonds and short the Japanese yen, it's the same trade. So I really watched my correlation risk as well with the markets I trade. But yeah, in a short sentence, I am much more sensitive that there could be sharp moves in the market, so I'm trying to reduce my risk accordingly.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure to be on with you. Thank you.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business. His website, Victor.Adair.ca. Coming up, Ted Dixon, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Ted, welcome back to This Week in Money.
Well, Jim, it's great to be back, and thanks for everyone listening in today.
Ted, can you tell us a bit about the Canadian Insider Club and IncResearch.com?
Well, sure. The Inc. Research platform has three websites. IncResearch.com is for our premium service. There's tools there you won't find anywhere else. But if you're just looking for easy to use insider data, so some filters, and a watch list to keep on top of what insiders are doing, CanadianInsider.com is another key part of our platform. That was also the first website, by the way, to provide real-time, free-to-air quotes for the investing public on Canadian stocks. So, yes, we have a lot of insider insights on CanadianInsider.com. But, we do try and go the extra mile to give people an edge in the market. And you can go to the CanadianInsider.com website. You can sign up as an intro member for free, get a starter watch list. And, when you're ready, you want to expand that watch list because there's lots of opportunities now, finally popping up in the Canadian market. You can join the club, expand your watch list, and get access to some core Inc. research reports. So that's basically an important part, I think, of anybody's investing strategy to take a look at least what the insiders are doing, so you know whether they're buying, selling, or holding stocks in the companies that you're watching or you hold.
What have insiders been doing during these volatile times in the large caps, mid caps, and juniors?
Well, in Canada, they have been sticking to their guns and seeing opportunity during these volatile times. And it's certainly a company-by-company basis, but on balance, on the TSX market, for example, we still have more companies with key insider buying than there are with selling. And that has been a pretty consistent situation so far this year, and it picked up a bit when we saw stocks pull back in the winter, when sort of we were maybe at sort of peak Trump derangement syndrome in the market. I think that's a term that people understand, where he can certainly get under people's skin and a bit of panic can set in, but that provided opportunities. Insiders were buying, and we have seen buying not only just across the board, but we have seen really the strong buying in the most economy-sensitive areas of the Canadian market. So I'm talking about the energy sector, I'm talking about the basic materials sector, and I'm talking about the industrials. So there's been a little less enthusiasm in the consumer cyclicals area. Now that includes sort of those consumer areas where, like restaurants, where you would, might spend some money, if you have extra money and you want to go out for dinner or something like that. But it also includes really things like auto parts and automobiles. So this is a really tricky area right now with the Trump tariff strategy, which really has two parts, in my opinion. Yes, there is the tariff part of the strategy, which apparently he's, as of our recording late in the week, here he's going to be putting 25% tariffs at some point on cars, but the details of that, of course, won't be known until April the 2nd, and maybe there'll be a delay after April the 2nd, but that gets into the second part of his strategy, and that is to generate uncertainty. So I know there's this feeling that he is kind of all over the place and doesn't really know what he's doing and changes his mind from day to day. Yes, some of that may be true, but I think part of it is by design. He wants to raise the cost of building a plant in Canada or Mexico because of the uncertainty around tariffs. So it's not just the tariff, but it's also this uncertainty around what will the tariff be? Are they going to go up? They could go up at any time. That's all part of the game he's playing. So the consumer cyclical area, we've seen a little less enthusiasm. We have seen a little bit picking up now, so we're watching it. It's improving, but that's still an area that we've got our eye on. Other areas in the market, the defensive areas, the defensive consumer, financials, healthcare, technology, they're all pretty good. We've got strong insider signals from all those areas. So this, has been an opportune time during this turmoil, this Trump tariff turmoil, to basically find very good opportunities in the economy-sensitive areas. And we are still seeing opportunities, because if we weren't, we would not have the Inc. indicator for the TSX at over trading, reading over 100%, meaning there's still slightly more companies with key insider buying than selling. That means there's still identifying opportunities. Doesn't mean those opportunities are going to last, because if we do get some sort of calming of the tariff storm, and if the Fed starts to cut rates, which I think eventually they're going to have to, you could see some of these stocks really start to rip. And at that point, the opportunity, becomes more speculative. So it's when there's this when these valuations come down because of fear, that's when you have to go through and see what insiders are buying and what they're not buying. And that's a really good screen that you can use to at least generate some ideas, where are insiders buying what stocks. And on Canadian.Insider.com, we do have some basic screens that you can look at every day. Again, if you join as an intro club member, you can visit and see what stocks are every hour, basically, both in Canada and the U.S. We also have U.S. stocks as well, and see where the insiders are buying and where they're maybe selling. So that can be an important screen, especially during these volatile times. You get a big swoon in the market. Look, you want to see which stocks are the insiders buying in this downturn, and are they selling any? Because that might mean that maybe the downside is justified. Now, I mentioned the Americans, by the way. We do have we do cover the American market. We covered a little bit more extensively on Research.com than we do on Canadian.Insider.com, but you can still get the filings and the filters, some filters on Canadian.Insider.com. And we're starting to see U.S. insiders pick up their buying a little bit. It is starting because stocks have come off, so the insiders are starting to nibble away in the U.S. Really stock-by-stock situation. Look, Jim, for the last decade and a half, there's been this dumb money strategy of just buying the S&P 500 and buying that mantra, well, you can't beat the market, just buy the index. And when you had the Fed running the show, just basically pumping money into the market, that made sense. And that just created a circle of money chasing, where the big companies got bigger and bigger because more money was flowing into these passive ETFs. Well, now we're starting to see a bit of a reversal, and I think this reversal is just getting started. We will see. But on the upside, we're finally seeing life in value investing in the United States. It's early days, so it will be a really, really interesting 5 years here. I think the 4 years of the Trump administration, then whatever comes next, it's going to be a really, really good period for stock pickers, both, in Canada and the United States. And, we're starting to see signs of life in the U.S., but still very early days.
Is watching what insiders do a good indicator of where the stock price could go?
Well, on balance, I can tell you that we've been tracking our signals in an index called the Canadian Insider Index on a live basis for 10 years. This index is calculated by a third party. It's not calculated by us. It's calculated by Selective, which is a large index provider actually they're based in Germany, but they calculate the index for us. So over the last we had our 10-year anniversary of the index in November, and over that period, the 10-year period, the first 10 years of that index, it outperformed the broad TSX basically by 3% a year, so just over 3% a year. So the index, by the way, the Canadian Insider Index, it's an institutional type index. Okay, so it is basically for those investors who need to invest their money, in a very liquid, large cap form. So family offices, investment advisors. So it excludes a lot of the smaller stocks, which you can even, in theory, do better on if you're tracking what insiders are doing and have a successful process that combines what insiders are doing with the opportunities that they flag. But basically, the opportunity you've got on the institutional level can be seen by tracking the Canadian Insider Index. It's also available on Canadian.Insider.com. So, we've got the track record that demonstrates the outperformance of the process that we use, and the important aspect of using insider data is not just doing blindly what the insiders do, but it's putting in context what the insiders do. And we've developed a process that looks at valuations, so how cheap a stock is or how expensive it is, along with the price momentum as a signal to determine, is there growth opportunities in the stock, and then how are insiders interacting with that opportunity. So, are they buying a cheap stock? Are they selling an expensive stock? That's how you use insider data, and putting it in context is really, really important. Just by looking at what an insider is doing, that insider bought or that insider sold. Buying is bullish and selling is bearish. I would call that sort of the naive strategy. And in our studies that we've done to develop the Canadian Insider Index, which uses the Inc. Edge Outlook ranking system, we found that the best approach is to combine insider activity with some other core factors, such as valuations and price momentum. So if there's one thing I can leave with your listeners, is that you want to look at insider data, but just by going and saying, we saw an insider buy this stock today. That's good. I'm going to buy some of that. That's taking a very risky shortcut. You want to see more. You want to see, why is the insider buying? Is the price gone down? How is this buying? What does it look like in relation to other of its peers? Like, is everybody in this peer group buying? Is this or is this a one-off? Is this the only company in this industry where it's got insider buying? Well, that can tell you a lot more than just, this person is buying, or maybe every company is buying. You've got insiders buying in every company. That tells you a little bit something different, that maybe there's an industry aspect to what's going on, or maybe it's just that time of the year when all these companies or insiders are given opportunity to buy in the market and through an employee plan, and they do it, so it's not really a big deal. So it's a good first step looking at what insiders do, and can be very valuable. And it's even more valuable, though, if you combine it in a disciplined process, and you can track, the process of the Canadian Insider Index on CanadianInsider.com, and it just shows you how important it is to have a disciplined process. I think in any type of investing, right? So it's equally important with using insiders. Insiders are part of a toolkit, part of your arsenal, and when used properly, it can be very helpful and can help build wealth and can help protect wealth as well. Especially if you see a lot of insiders selling, that should get you at least. Usually, it should at least get you checking your conviction level of a stock. But again, by putting it into context, if you see a lot of insider selling, but the stock is ripping and it's like one of the most best performing stocks in the in the world or in the country, well, maybe it's not a big surprise that insiders are selling at that point. And that, again, it's putting it in context. And that's what we try and do with our Ink Edge Outlook signals. And you can get those for free, by the way, on CanadianInsider.com. So we were the first, and I believe we're the only site that has quantitative rankings that incorporate insider commitment. Now, the ranking, the Outlook rankings that you see on CanadianInsider.com, they are once a month. They're not updated as frequently as they are on InkResearch.com. And if you're a member of the Canadian Insider Club, you can get an updated version. We give you can upload 30 company reports a month to get the updated Outlook whenever you want. So, yeah, putting insider activity in context is really, really helpful, and it's basically what's kept us going as InkResearch.com. If we weren't adding value for our users, we're 100% independent. We just work for our subscribers and our members. And if we weren't being able to add value, we wouldn't have been doing this for over 20 years, which is, we started the Ink Research back in 2004. So, and fortunately, there's been some tough times during leading up to COVID when all the money in the world was flowing into the U.S., and we saw it again with the NVIDIA bump, but times have changed. And I think the big pivot for global investors happened in late January, and it was when DeepSeek announced revealed its competing platform to ChatGPT. That was a massive game changer, and it wasn't just because it could compete with ChatGPT, but it had global investors rethinking the whole premise that the United States was going to be the technology superpower. Never mind the geopolitical superpower. For investors, the major foundation of this late stage surge in passive investing, this just putting money into the S&P 500 ETFs and the other passive ETFs, a lot of it was driven under this core assumption that U.S. technology was unparalleled and unmatched. Well, it is still the leader. I don't think there's any doubt that American innovation is still the leader, but it now has clearly a significant challenger in China. And that has shaken up the assumption that all you need to do is put, most of your money, and I'm not just talking about individuals, I'm talking about large institutions here. I'm talking about, some large central banks, and pension funds. Well, you just need to put your money into the U.S. market, and that's all you need to do, and because that's where everything's going up all the time. Well, that narrative, those assumptions have to be revisited after what we saw with DeepSeek and what transpired following DeepSeek with other Chinese and American competitors coming out with different AI products that are going to drive down the cost of using AI across the world. And now it's looking for who is going to be able to profit from AI, not who is delivering the AI software. So as much. So, and I'm sure there'll still be profitable businesses doing that, but the race now is much broader. So broad opportunity is really good for active managers, for individual investors who have the risk tolerance to move outside of passive index funds. Now, look, there's still a good case for passive indexing. I don't want to, this isn't investment advice. This is just a description of how the investment environment has changed. So the assumptions driving the outperformance of passive investing in the United States, I think now those foundations have become a lot weaker, and the foundations for active investing and stock picking have become a lot stronger.
Do insiders tend to buy and sell based on seasonalities?
Insiders tend to buy and sell based on price, generally, discretionary buys and sells. And a lot of times those will coincide with seasonality. But, for example, we've seen a lot of insider activity in the Canadian energy sector. Now, we've seen a lot of that take place in the winter. That's typically a weak period for stocks. And when that plays out, it's not unusual to see insider buying pick up in the winter. So I would point to price action as more important than seasonal action. It just so happens that a lot of times the two are closely related.
Are there more and more regulations on how insiders can buy and sell, and do you think regulators care what insiders do?
I think that regulators care about insider data because it's important that investors see it, and I think that they rely on the transparency of insider disclosure as one way of protecting market integrity. So there have been some firmly established rules about what insiders can and cannot do. And for the most part, I think they're well understood. So, that's been in place now for a long time, like many decades. So there has not been I would say, I wouldn't call it, there hasn't been a growing kind of regulatory amount of paperwork that insiders have to do. Insiders should be well familiar with their obligations, and for the most part, they stick with it. Yes, there'll always be exceptions. There's always exceptions. There's always exceptions in everything, right, Jim? I mean, there'll always be bad actors in different areas, but no, the requirement for disclosing has been in place for many, many decades, and most insiders, the vast majority of insiders, are well aware of their obligations. And I've been doing this for 2 decades, and I will say that for the most part, they do it. There are exceptions, and there are situations where some actors know how to play the system, right? So there is some of that going on, and you have to be really mindful of that in junior startup companies. So there's junior startup companies, whether you're talking technology or mining, in U.S., OTC, bulletin board, those are risky companies to begin with, and in my experience, those are the ones you have to mostly be really kind of do your due diligence on the insider holdings. So that's really key. You can get holdings summaries of insiders off of CanadianInsider.com by getting a company report or on IncResearch.com. And you want to see not just whether they're buying or selling. There's lots of websites out there that have, this person's bought and this is how many shares they have in their account. You want to look at the holdings, and you want to certainly look at how that's changed over time. And the holdings tell you a lot, how much skin is in the game that the insiders have. And if a company does not have, especially a smaller company, a new company, a junior mining company, if they do not have significant holdings, right? If you look and you see, the CEO only has 100,000 shares or 50,000 shares, and all these insiders together, they only have, they don't even have 1 million shares, and the stock floats, 100 million, 50 million, why is that? who's got the shares then if the insiders don't have? Like, now the insiders aren't going to have all the shares, but if they don't have, if they don't have a couple of, every company's different, the float's different, so I can't put a number on it, but we do break them down on IncResearch.com, whether company has above median or below median beneficial holdings. You can usually tell after you look at enough of these, which ones are standing out as being, suspect for more due diligence, right? If there's only nominal holdings amongst the insiders, that really requires additional due diligence in that company as to why.
By watching what insiders are doing now, can you predict where stock markets are headed?
Well, we look at sentiment indicators. I talked about the insider buying, for example, in energy. Generally, insiders are contrarians, so you would expect to see insider buying pick up as stock prices fall. So we're starting to see that in the United States. That's a good sign. What would be a bad sign is if they were all sitting on their hands. So that's why I had a constructive take on the trend for stock picking in the U.S. On the other hand, because they're contrarians and insider buying, for example, is just picking up in the U.S., really what that's reflecting is downward momentum in stock prices. So in the early stages of a market correction, you're going to see insider buying pick up because as contrarians, they're going to start picking up opportunities, but it's also a reflection of falling stock prices. So until you see a point where you're at peak insider buying, where basically it looks like our indicators have peaked and started to roll over at high levels, you don't really have a lot of confidence that the market has found a solid floor of support. So insider activity in our indicators at the market level and the sector level can be very helpful during extreme market conditions where you've got a lot of hype, where the market's ripping to the upside, and then if you see peak insider selling at that point, you probably have hit a major resistance point in the market. On the flip side, if markets are tanking and for whatever reason, and insider activity is soaring and it looks like it's maybe even peaked, then you have a lot more confidence that the market has found a point of support, a key point of support. Now, there's, of course, lots of scenarios in between those two extremes. That's when, at the market level, the insider activity is the most valuable and the most important. Because, how many times have investors, including myself, right, stayed at the party too long? You think it's going up forever, right? And it keeps going up and up, right? And it's a lot harder, though, to gauge the top, even with insiders, than it is to identify a potential bottom. Because the bottom, you have not only do you have the insiders signaling that things are overdone by a big spike in an Inc. indicator, insider sentiment, but you could tell from other investors and business television broadcasts that everyone's panicking and everyone's downgrading their views on the economy and the market. And when you see peak insider buying at that point, it can be a very, very valuable window to see that the market is offering you opportunity to get in at very attractive prices.
Do you think we're setting up for a sell in May and go away scenario?
I think that rule of thumb works during your typical time, and I'm going to stick my neck out and say that it's different this time. And why is it different? Well, because Trump 2.0. And I think that Trump 2.0 is different this time. Now, if one believes that markets are just going to look through all of this and behave as normal, that may well be. But I would just be cautious on that rule of thumb. That being said, there's a lot of risk happening this summer, so I don't want to dismiss having defensive positions and cash positions this summer. I'm not saying that at all. I'm just saying that I really don't know what's going to happen this summer at this point, except that we're starting to, we've seen we've seen good opportunities this winter pick up. So getting too cute, I think, in the world of Trump 2.0, I mean, yes, if you're a trader and you've got technical signals that you believe are very robust, that's a different story. I'm not talking about that. That's not our expertise. Yes, we do look at basic technicals in conjunction with what's happening with insiders. But for the most part, I'm talking about strategic investors who have, more than a couple of hour holding periods or a couple of day holding periods. You've got some big opportunities right now. We're seeing big geopolitical, geoeconomic shifts. Selling may go away, yeah, maybe, but I don't know. I think there's so many bigger picture developments, bigger picture macro shifts going on right now that rule of thumb, I think, is just secondary. It may work out to be you don't want to be in stocks in August. I don't know. I mean, the U.S. budget reconciliation package, that's, for the Trump tax cuts and the debt ceiling, I believe, those still have to be addressed. And who knows when that's going to hit a climax. Maybe it will be this summer, and maybe there will be a big market sell-off in advance of that. Maybe it will get done this summer, and maybe the markets will soar in the summer. We don't know. But the big geoeconomic trends that we've picked up, and that's basically that you've got this continued tailwind for gold. You've got this continued tailwind for copper. You've got this geopolitical risk surrounding energy. You've got this trend towards using natural gas more and more, not just for AI generation, but just basically to power economies around the world. Those are big trends that really, if you want to get cute around them, that's fine. Just make sure you've got a really cute system that works. But I don't think you want to get shaken out unless you've got some very, very high confidence that there's trouble ahead across the board. And we may get to those situations. And if we start seeing a lot of insider selling in those three sectors, in energy, in basic materials, in the industrials, then we will get worried. But we aren't at the other end of that. We are in the opportunity zone, not the worry zone at this point. Where this is still a lot of examples that we're seeing that this could be sort of generational type opportunities, especially in the mining area, which has been forgotten and hated. Who needs mining? And mining companies, they destroy shareholder value, and too risky. And I mean, I'm sure a lot of your listeners are well familiar with the stigma that the mining industry has had, and that is not a sufficient condition for having a major multi-year bull market. But it's certainly, I think, a necessary condition where you've got lots of global skepticism towards the group and sentiment still kind of on the rocks, pardon the pun, and I mean, these are the times that offer opportunities, but you also need confirmation that things are going to get better. And given what we're seeing on the insider side, and especially in terms of Trump 2.0, the policies that he's bringing in, I don't think there's ever been a better time in my investing life to be looking at Canadian listed mining stocks. This is probably there's been big run up. We had a nice move during the Bernanke money printing era at 2010, 2011, but those were just fueled by money printing. And we did have a nice, we also had a monetary fueled rally back before the great financial crisis, but now we've got some big geoeconomic trends. We've got, Trump putting potentially tariffs on copper. Well, we still don't know, but he's hinting at it, right? Tariffs on copper. And you've got him being very, very aggressive to other U.S. allies. And the problem with that is that some of these allies are major funders of U.S. deficits. So what is all that going to do to the U.S. dollar over the next 5 to 10 years? I don't see the bullish case for the U.S. dollar over the next 5 to 10 years in that environment. Tariffs will support the U.S. dollar to some extent, but we've already seen evidence that the ability for tariffs to prop up the U.S. dollar is been surprisingly weak. So there's big developments going on that go beyond the Fed and who's in charge of the Fed and the next Fed meeting. The Fed is as hostage to Trump 2.0 as investors are. Like, we are hostage to what the direction the Americans take on their policy. We just, like, in other words, when I say we're a hostage, we're going to be dealt cards, and it's up to us to play them, right? So the Fed is in the same boat. The Fed is given these tariff cards, and they have to play them. So the Fed is reacting more than it's ever reacted before, and it can't financially engineer outcomes as easily as it did before. And if it does get into the position where it does have to financially engineer outcomes, that's going to likely be supportive for the commodity complex, because it's likely going to have to engineer support for the Treasury market, because the Treasury market is getting bigger and bigger and bigger every minute, basically, or every week. So, although right now I believe there's because of the debt ceiling that may not technically be the case, but in any event, that's just delaying the extra Treasury issues that will have to be brought to the market later. So the Treasury market's getting bigger. If anything, the Fed will be called upon to make sure that runs smoothly. I don't see that being commodity negative at all. If we were into a hyperinflationary environment, that's a different story, because then the Fed would have to react to that by jacking up interest rates, which would be commodity negative. But inflation is still stubborn in the U.S., but it has been coming down, and I think there's bigger risks in the U.S. market than inflation right now, and so the Fed will have to react to those. So putting the Trump 2.0 together with the Fed having to be basically on standby to make sure the Treasury market is going to be running okay leaves this setup that I've never seen before in my multi-decades of participating in the financial markets, where the hard assets of gold, silver, copper, zinc, titanium, all these really hard elements that go into making things, and unfortunately making weapon systems. Yeah, that's the foundation of the economies that are being reset globally, and critical minerals are the foundation of the industrial economy, and gold and silver is the foundation of the monetary economy. There's never been, Jim, a better time, I'm telling you, to be focused on what's happening in the Canadian mining space than right now.
Ted, where can people follow you?
Well, I'm on X right now. So Ted Dixon on X. So the Inc. Research also has a LinkedIn page, Facebook page, so you can follow us there. We do put some reports on there for free for people, and some updates, and also you can follow Canadian Insider and Inc. Research on X as well.
Now, just going back to what you said, never a better time for Canadian mining space. Does that include junior gold miners that have been taking it on the chin for such a long time?
Absolutely. Absolutely. They're just starting to just sort of perk up now. The venture and CSE stocks have had a pretty good year so far in 2025. So what will happen, I think, is that as the investing demand for the bigger companies from these institutions, family offices, central banks, go towards either gold or senior gold producers, these gold producers will have to increase their reserves and their assets, their projects. So you will start to see more and more deals between the senior producers and the junior producers. So this is going to be a very, very, very exciting time for the juniors. Again, though, the juniors are riskier. So it's really important to see what the insiders are holding. And there's still some good services out there that can provide you with some fundamental research. Not that many. There's a few that are independent, and you have to really make sure that the newsletter writer or the researcher is not being paid by the company to promote it. This is really critical. Okay, because when this market gets going, you're going to have a lot of opportunists who are paid lots of money to pump junior stocks. Okay, stick with the researchers who get paid by their subscribers who don't get paid by the companies. Okay, and so you got to do your research, take a look at what the insiders are holding, if they're really got their skin in the game, or if there's something else going on. And then you can also combine that with some fundamental research into the mining opportunity. So it is hard work, but the rewards can be substantial when you've got the right market for it. And I think we've got the right market for it now.
Ted, thank you so much for being on This Week in Money.
It's great to be back.
My guest has been Ted Dixon, CEO and co-founder of Research.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Ted Dixon. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HoweStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.